Well, look, you certainly have to put the bond market move that took place on Friday in the context of the larger move that has happened over the last 5 or 6 weeks. And I agree with you. The reason that the bond yields have moved up so much since late September is because of the so-called Trump trade. If you recall, Trump has really three core policy agenda items. It's restriction on immigration, it's higher tariffs, it's lower taxes. The market deems all of those to be, to some extent or another, inflationary. And as everyone who's taken, introductory economics knows, when inflation is deemed to go up, not just in the short term, but in the long term, as the impulse from these policies takes effect, nominal assets whose coupon values or whose payoffs don't adjust with inflation, tend to suffer. Bond prices go down, yields go up. I think it is absolutely no coincidence that the move higher in yields that we've seen coincided about 5 weeks ago with the bottoming out of Trump's prospects in the betting market and in the polls.
Thierry, back to the data and back to the Fed, notwithstanding the surprise that we got on Friday with October payrolls, the US economy has shown unexpected resilience, hasn't it? So is that consistent with the Fed cutting by 25 basis points this week, then in December pausing the easing cycle, and how much guidance off that do you think we'll get in the commentary, and ultimately is that going to be a pro-dollar story?
Yeah, no, these are great questions. My view, of course, is that the U.S. economy has pockets of weakness. I wouldn't say it's weak. I would certainly agree with the idea that it's resilient, certainly to higher interest rates. But that should not obviate the fact that we've had slowdown in hiring. We've had some stress among low-income households with regard to delinquencies. We've had a slowdown in the housing market, for example. There's still the overhang from commercial real estate and offices. All of these things are militating in favor of a slowdown. Now, having said that, one would think that this is still a great time for the Fed to continue to ease rates. The problem, of course, is that we have an election on November 5th. And when the Fed meets on November 7th, it may want to preserve its credibility in the face of a market that might want to push inflation break-evens higher if Donald Trump wins, i.e. an extension of the Trump trade. What would happen, in other words, if from roughly 2.35% now, the 5-year break-even, inflation break-even breaks above 2.5? Would the Fed see that as the market anticipating more inflation? Would the Fed have to respond? We think it's around those levels, another maybe 20 basis points higher in 5-year break-evens, if it were to happen, where the Fed might start to consider, if not putting a halt to rate cuts, certainly issuing a more hawkish tone in its statement, maybe making reference to the rise in inflation break-evens that we've seen over the last 5 weeks as a way of trying to suggest to the market that December is not a guaranteed cut.